Hello guys, this is Chetan Kansara. I am a chartered accountant and I teach the subject of finance to the students of ACCA, CFA, CA and CS. I have an experience of more than 25 years in this subject. Guys, today we are going to start with a very important chapter of ACCA FM 9 skill level paper. Very important. In section C, we get a 20 marks question from this particular chapter. Now this chapter name is obviously investment appraisal, or we can say investment decision. Okay, now what do you mean by this investment appraisal and investment decision? We'll start with what is investment decision? What is investment appraisal? We'll take an example. Suppose for example you want to purchase say a bike. How you're going to take the decision? If you want to purchase a bike, how will you take that decision? First of all, you have to decide your budget, right? What will be your budget? Because bikes are at a lower price also. They are very costly bikes also. Hayabusa and many other bikes you know very well. So there are many different varieties of bikes. So first of all, what fits in your budget? Then after the budget is decided, in your budget, which are the options available? Say you can buy bike A or B or C. Then say for example you will be deciding what is the resale value, which bike has a higher resale value, which bike's performance is good, which bikes provides higher mileage, right? Which one will have a higher life? So when you want to purchase a bike, we want to purchase a car, how much we have to think? Same way in a company, when it is making a huge investment decision, when it is purchasing a machine worth of say 50,000 or $1 lakh, right? It's a huge investment. So there also some investment decision has to be made, some appraisal has to be done, and then the investment is made, right? So here in this chapter what we are discussing is how to take this decision. How will a finance manager decide whether to purchase a particular machine or not, whether to accept a project or not? Suppose company is getting a project, two projects, project A, project B. Which project is profitable? Suppose company wants to buy machine, decided machine A should be purchased or machine B should be purchased. These type of decisions we are going to take in this chapter. Guys, very important topic from exam perspective, plus practically also. This decision is very important. Why? Three reasons. Number one, it is a long-term decision. Suppose when you purchase a bike, what is the life? The bike's life will be 7 years, 10 years, 6 years, depending on how the person is using obviously. But we have to use it for more than a year. This is not a short-term decision, it is a long-term decision. Similarly, when company purchases machine, it has a life of 10 years, maybe 12 years or maybe 15 years. So why these decisions are important? I said three reasons. Number one, these decisions are long-term in nature. Number one. Number two, they involve huge money. Right? Huge funds. So decisions are important. And number three, these decisions are irreversible. These decisions once taken, and if you try to reverse, there will be a loss. Say for example, you are constructing a building, company is constructing a building of 10 floors and 3 floors are completed, and if company thinks, chalo, let us change the place, let us change this place and shift, is it possible? Not possible. Once you have constructed 3 floors, cost is already incurred. Now if you try to shift the place, there will be a huge loss. So these decisions once taken and then you reverse, there will be a loss. Now, so these decisions are important. What type of decisions, what type of appraisal you have to do, what type of investment appraisal you have to do. We have to decide whether to purchase a machine or not, whether to accept this project or not, whether to accept project A, project B, project C, which one is better, which machine to buy, A, B, C. These type of decisions we normally take in this topic. Now these decisions are to be taken using some important techniques, right? There are many different techniques. In this chapter number 2, what is the name of the chapter? Basic investment appraisal technique. Basic techniques. The other technique, little more complicated techniques, we are going to take in the next chapter. Okay, so which type of techniques we are going to use? There are two categories, we can say. One is basic techniques, where we are ignoring time value of money. Sir, what is time value of money? We will discuss in the next topic, next chapter. In chapter number 2, we are not covering time value of money. This is the basic difference, right? So in chapter 2, the techniques which we are covering ignores time value of money, and the other chapters which considers time value of money is being covered in the next chapter. Okay, now guys, we are going to obviously use Kaplan material, but I'm just taking a different format for reading the data. This is, I find this more comfortable. Okay, it's the same content, absolutely same content, no difference, but the presentation is little different. Okay, so I'm using this material. This is Kaplan material only. Fine. Now what we are discussing in this particular chapter, investment appraisal techniques. In this chapter, we are going to discuss what is accounting profit and what is a cash profit. What is the difference between cash flow and profit? Number one. Number two, cash flows and relevant costs. Some costs may be irrelevant for decision making. We are going to discuss that in detail later. And number three, the two basic techniques of investment appraisal. One is ROCE, return on capital employed, and other is payback. So we are going to cover these two techniques in this chapter. Let us start with ROCE directly. Let us not waste the time. Okay. Now, what is ROCE? This is already we have discussed, but still let us have a read. One stage in capital budgeting process, investment appraisal is also called as capital budgeting. Budgeting of capital expenditures. Budgeting of what? Capital expenditures. These appraisal has following features: assessment of level of expected return earned for level of expenditure. How much you are spending. Investment decision we are making. We are going to spend and we are going to get some cash flows. So there are two things. One is outflow, one is inflow. How much you are spending, how much you are getting in return. How much you are spending and how much you are getting in return. Okay. Estimates for future cost and benefits over the project life. We are going to estimate the future, because see, we are doing capital budgeting of capital expenditure. We have not yet made the investment. We are planning to invest. So we are going to estimate the future cost and benefits over the project life. Okay, and this estimation of cash flows, actually we don't have to do practically. It will be given in the questions. Okay, so two basic appraisal technique. We are doing ROCE and payback. Let us start with ROCE. Now this ROCE, it is also called as ARR method, accounting rate of return, or we call it as average rate of return. Accounting rate of return, or we call it as average rate of return. There are two formulas. There are two formulas for this. Average annual profit before interest and tax divided by initial capital cost. Or second formula, average annual profit before interest and tax divided by average capital investment. Average capital, this is initial and this is average. That's the difference. So what is the formula? Average profit before interest and tax, earning before interest and tax upon initial capital cost. Now sir, what is the logic of this calculation? Say for example, you are starting with planning a project, okay, and we have some estimation of EBIT, earning before, profit before interest and tax, okay, for year 1, year 2, year 3, year 4, year 5. In different years, we are expecting different cash flows. We are expecting different cash flows, right? Different profit, EBIT. So we have to add all and divide by 5, and then we divide by initial capital cost. What does it mean? It means if you invest, for example, suppose you are getting a profit of say 25,000. This is average EBIT, average earning before interest and tax. Have you got this? Add all, divide by 5. Divide by, say for example, you are investing 1 lakh. You are investing $1 lakh and we are expecting an average profit of 25,000 into 100. So what is ROCE? It is 25%. If you invest $1 lakh in this project, then you can expect a 25% average return. In some years the return will be higher, some years the return will be less, but we can expect an average EBIT of 25%. So on an average 25% EBIT can be earned in this project. Now second formula, average capital investment. Now why average capital investment? Why we take average capital investment? Now see, for example, suppose the average EBIT is 25,000. Average profit before interest and tax is 25,000. Now what we want to do is, we want to find out the average return in the coming 5 years from the project, right? In the numerator up, we are taking the average profit. Then in the denominator, you should take average investment. Suppose if the assets are depreciable, I repeat, if the assets are depreciable, then is the value, say for example, it's a machine and the machine is worth say $1 lakh. $1 lakh is the cost of the machine. Now this machine will be depreciated in 5 years, as I have taken 5 years, so 20,000 will be depreciated every year. 20,000 will be depreciated every year. Yes or no? So now if it is depreciated by 20,000 every year, is your investment in machine same every year? No. In this project the investment is reducing 1 lakh. In the second year it will be 80,000. Why? 20,000 depre. So suppose in year, we'll take year 0, year 1, year 2, year 3, year 4 and year 5. What is the value of machine today? It is 1 lakh. 20,000 depreciation. At the end of the first year it will become 80,000 approx. The value of the machine, 20,000 depre. Then 60,000. Then 40,000. Then 20,000 and then nil. Right? So what is the average investment? Add all, divide by 6. So that will be 1 lakh. Just add up how much it is. See, 1 lakh plus 80,000 plus 60,000 plus 40,000 plus 20,000 divided by 6, because you are adding 6 figures. Okay, 1, 2, 3, 4, 5 and 6. So divide by 6, that comes to 50,000. So we can directly write average capital investment like this. Initial investment divided by scrap value. What is initial investment? Say 1 lakh. What is scrap value? I have taken 0. Divide by 2. 50,000. 50,000. So investment in the 5 years is also not same. Right? This is also one of the approach. Right? So there are two formulas. One is average profit before interest and tax upon initial capital cost. Average annual profit before interest and tax upon average capital cost, average capital investment. Okay, but in absence of information, you use the first one. Unless they tell you, you don't go for the second formula. Use the first formula. Okay, use the first formula, because see, depreciation is a non-cash item basically, but we have spent 1 lakh rupees. See, we get tax benefit on depreciation, but we are not recovering depreciation as a cost. Getting it? We transfer depreciation in P&L and we take the tax benefit. But are we recovering the entire cost? No. So your initial capital cost is 1 lakh. That 1 lakh is lost. That 1 lakh is lost. Unless you get some scrap at the end. Getting it? So it is logical to use the first formula. So use the first formula. Okay, in absence of information. Now, some decision rule. If expected ROC of the investment is greater than the target, for example, company has estimated a target of say at least 12% return from this project, and company is getting say 15% ROC. That means the average rate of return we expect to get is more than the minimum hurdle rate, minimum rate which company expected. We should get at least 10% because that is 10% is the cost of our funds. So I should get more than 10%. Suppose the answer over here is 12%, 13%, 15%, then I should accept the project. Okay, so what is ROC? ROCE, we can say return on capital employed. It is also called as ARR. Okay, two formulas. Now we'll just practice. A project involves the immediate purchase of an item of plant costing $1,10,000, $110,000. It would generate annual cash flows of $24,400 for 5 years. Okay, in year 1. The plant purchase would have scrap value of $10,000 in 5 years. Now see, first of all, understand the difference between cash flow and earning before interest and tax. When I say cash flow, it should not cover non-cash item. See, understand. You have earning before interest and tax. Okay, we want earning before interest and tax. Out of that, see, when you calculate EBIT, you must have deducted depreciation. Earning before, profit before interest and tax, before interest and tax. So interest is to be deducted, tax is to be deducted, but all other expenses are already deducted in the above calculation, right? So depreciation you must have deducted. Then only we will calculate profit before tax and then tax and profit after tax, right? So we must have deducted depreciation, but I want EBIT, and here it is given cash flow, understand, right? So what you have to do is, out of EBIT we add back depreciation and then we get cash flow. Okay, so what is the cash flow over here? Your cash flow is 24,400, right? 24,400. And what is the depreciation figure? 1,10,000, and the scrap is 10,000. Scrap is 10,000. So 1,10,000 minus 10,000, that is 1 lakh, divide by 5. So 20,000. So 20,000 must be depreciation. Yes or no? So depreciation must have been deducted. I have to add back. Sorry. So when I go reverse, I have to deduct the depreciation. Go reverse. So that will be 4,400. Okay, I repeat, cash flow and EBIT. I want EBIT over here. I don't want cash flow. Now how the cash flow is calculated we will discuss. But EBIT amount must be after deducting depreciation. So I have to add back depreciation to get the cash flow. So remember, you add depre and you get this cash flow, and you are given cash flow. So you go reverse, you have to less and then get 4,400. 4,400 is the earning before interest and tax. To that, depreciation 20,000 must have been added and you are given 24,400 as the cash flow. Okay, now how do you calculate this cash flow? We are discussing that and then we move further. Cash flow, revenue, sales, minus all expenses, variable cost, fixed cost, depreciation, all expenses are deducted. Then we get EBIT, getting it, earning before interest and tax. So depreciation is already deducted, but depreciation is a non-cash item. So we have to add back depre back. We have to add depreciation again. We deducted depreciation, we again add depreciation. When we add depreciation, I get cash flow. We must have added, so I have to deduct again, reverse. So and we get 4,400. So what is the project ROC? Using the first formula, initial capital cost upon average capital investment. What is initial capital cost? Initial capital cost is 1,10,000. And what is your, so what's the answer? Okay, so that comes to 4%. That comes to 4%. Then the second one, project ROC using average capital investment. So what is the formula for here? What is the formula? It will be average EBIT divided by average investment. What is average investment? Cost plus scrap divided by 2. How much is the cost? It is 1,10,000 plus scrap. So 1,10,000 plus 10. So that is 120 divided by 2. So that comes to 60,000. So 60,000 is your, right, into 100. So that comes to how much? Divided by 7.33%. Okay, now what was the important point over here? This was the important point. It was given cash flow, but I want EBIT. So depreciation must have been deducted. You add back and then you get cash flow. So when you go reverse, cash flow minus depre, and I'll get EBIT. Okay, let us take the second example. A project requires initial investment of $8 lakh and earns net cash inflow as follows. Year 1, 2, 3, 4, 5 up to 7. Cash inflow. Again, cash inflows are given. So depreciation you have to deduct. Because to get cash flow, depreciation must have been added back. Right. But I want profit before interest. I want profit, book profit, not the cash profit. Okay. Here in this formula we use EBIT. Okay. So what you have to do is, cash flows are given, you have to deduct depreciation from this figure, right? In addition, at the end of the 7-year project, the assets initially purchased will be sold for $1 lakh. So 1 lakh is the scrap. So how much will be the depre figure for this particular asset? It will be $8 lakh minus $1 lakh divided by 7 years. So that is 1 lakh. So $1 lakh will be the depre for this asset, right? Now, first formula, initial capital cost, that will be average EBIT. Average EBIT, remember. So if I add all figures and divide by 7, I will get the average cash inflow. And I want average EBIT. So average cash inflow depreciation you have to less. This is depreciation per annum. So I can say this is average depreciation. This is for 1 year. Right? So this is average depreciation. What is average cash inflow? So average cash inflow will be, just add all and divide by 7. So that is 100 plus 200 plus 400, again 400, 300, 200 and 150. 1750 divided by 7. So 250. So what is your average cash inflow? It is 250. And then you deduct average depre. Obviously this is depreciation per annum. That is depreciation per annum, 1 lakh. So that is $100, $100,000, right? So here you get 150 is your average EBIT, earning before interest and tax, profit before interest and tax, $150,000. Now use the formula, initial capital cost. So here the answer will be, for A, the answer will be what? 150 is the average profit before interest and tax upon initial investment is 800,000, right? Okay, so into 100, that comes to how much? So this will be 150 divided by 800, 18.75. Okay guys, then next one, average capital investment. So average profit will be as it is. average EBIT in the numerator as it is, and divide by average capital investment. So that is cost plus scrap. So what is cost? 8 lakhs. And what is scrap? 1 lakh. So that will be 9 divided by 2, 4 lakh 50. So 450,000 into 100. Okay, so 150 divided by 450, 33.33%. Okay. Okay, so let's proceed further. Initial capital cost. Now this initial capital cost will include what? Initial capital cost will include, number one, cost of the new asset bought. You are purchasing a machine, say $100,000, that will be included. That will be initial capital cost. Net book value of the existing machine to be used in the project. You already have a machine, and for this project you are using that existing machine. So that machine is also a cost, because already it is purchased. It was purchased earlier. It's an existing machine, but that machine also costed something to the company. So for this particular new investment, this existing machine will be considered as a cost. Investment in working capital. Working capital is money required for day-to-day activities in the business. For example, suppose you purchase a machine. Now, for every machine you need raw material. Without raw material you cannot run the machine. So suppose you are purchasing a machine, and this machine you are purchasing for the first time. Okay, we don't have such type of machine in the factory. So how that machine will run? We need stock. We need to invest something for stock. So 1 lakh you are investing for machine, and 10,000 you are investing for stock. So this 10,000 which you are investing in stock is called as investment in working capital. You buy stock, goods will be manufactured, goods will be sold, the customers will pay you, again you will buy stock, again you will manufacture. It's a cycle. So this is nothing but working capital. Okay, that is also initial capital cost. In this initial capital cost, what you are going to cover? Then third one is capitalized research and development expenditure. All those research expenses which you capitalize, which you add to the asset, that will be also taken as initial capital cost, and ensure that this is amortized against profit. So these are, for example, say patents. Okay, for example, trademark. These are amortized. Fixed asset, tangible asset, we call it as depreciation, but for intangible asset we use the word amortization. So these 4 items will be included in initial capital cost. Okay, let's proceed further. What are the advantages and disadvantages of ROCE? Number one, obviously it is very simple. Number two, it links with other accounting measures. For example, EBIT. We take accounting profit. ROCE is the only method where you take the accounting profit, book profit. We are taking EBIT. In all other methods, we take cash flows. Cash flow, cash profit. We are interested in actual cash. But ROCE is the only method we take EBIT, book profit. Okay, so it links with accounting measures. Disadvantages: no account is taken of the project life. No account is taken because we take average, no? So we are not concerned more about the life of the project. We are interested in average profit. Timing of cash flow. We are ignoring time value of money. Sir, what is time value of money? How we are going to cover? How this time value is ignored? We are going to take in the next topic, next chapter. Okay, third chapter. It varies depending on accounting policies, because see, we are taking average EBIT. Now say for example, we are taking project A and project B. Project A is given by some company and project B is given by some other company. Okay, and they want certain, they have their certain calculations. Say project A, the company which is giving this project, they use SLM method, straight line method of depreciation, and these people are using WD method of depreciation. So their expectation will be different, their calculation will be different. So accordingly we will be also affected, and it is depending on the accounting policy. For us, for the company who is taking over the project, Okay, say for example, are using straight line method, depreciation will be same every year, right? But if you go for WDU method, every year depreciation figures goes on reducing. It goes on reducing. Say for SLM method, say 1 lakh is the cost, 20% depre. So every year 20,000, 20,000, 20,000, 20,000. But if you go for WDU method, on 1 lakh 20,000 first year. Second year it will be 1 lakh minus 20. On 80,000 it will be 20%. That will be 16,000. So depre figure is reducing in WDU method. In SLM method it is not reducing. So accounting policy will affect us. It may ignore working capital because many a time it happens, like we insert the initial stock, say 10,000 I gave earlier information example, right, over here, but later on we may have to put another amount for stock that may not be covered over here. It is difficult to estimate now. I repeat, we invest 10,000 for stock as a working capital, but later on we may require or next working capital, more working capital that may not be covered over here. Okay, it does not measure absolute gain. We are not talking about cash profit, we are talking about book profit. That's why there is no definitive investment signal. ROC is the least important method, we can say. We don't get a proper signal whether to go for this investment or not, because they are not considering cash profit, they are considering book profits. Okay, so this doesn't give a buy signal or sell signal very clearly. Okay, advantages and disadvantages, this already we have discussed. You can just go through this. We have already discussed this, right? Okay, now accounting profit and cash flows. Let us understand this concept. In capital investment appraisal, it is more appropriate to evaluate future cash flow than the accounting profit. In ROC, what you have taken? You have taken book profit. We have taken EBIT. Which is more better? EBIT or cash flow? Cash flow is better, because in real world we talk about only cash and cash. Remember, profit cannot be spent, cash can be spent. Profit cannot be spent. For example, suppose you have a profit of net profit after tax, you have a profit of $50,000, but you see the cash balance, we don't have cash balance. Then what's the use of that profit? Profit cannot be spent, cash can be spent. Okay, we cannot say I have 50,000 profit in my books, okay, give me this machine. You have to pay money. Profits are subjective. Profits are subjective depending on the method of depreciation, depending on the method of accounting, method of stock taking. Okay, profit differs, but cash, no, it is cash. Remember, you use any method of stock taking, LIFO, FIFO method, you use any method of accounting method may change. Okay, so profit is subject to accounting policies, but not cash. Cash is required to pay dividend. Company has to pay dividend to the shareholders. For that, company requires cash. Only profit is not enough. Say for example, company's net profit after tax, PAT, okay, is say $1 lakh. Now company wants to declare dividend, but if the company doesn't have cash, then what is the point of declaring the dividend? So book profit, net profit after tax is not enough to pay the dividend. We need cash. So cash flows are more important as compared to accounting profit. Okay, now profit versus cash flows. We need to read this. Cash flows are a better measure of suitability of capital investment because cash is what absolutely ultimately counts. Profits are only guide to cash availability. They cannot actually be spent. Same thing here, it is explained. Profit measurement is subject to the time period in which incomes and expenses are recorded on and are the matter of judgment. For example, accrual method. Some companies they use accrual method. Some companies use cash method. So accrual method means say outstanding salary not paid, but still you are going to write in P&L. You are going to write in profit and loss account because outstanding is not paid. So what profit you get is not equal to cash. Okay, Then cash is used to pay dividend. Dividend are the ultimate method. So that is already we have discussed. So these 3 points we have already discussed. Okay. Then this also we can just cover it. Major differences in cash flows linked to T. No problem, not required. We can just go through this directly now. Cash flows and relevant cost. Very, very important concept. Now guys, for all methods of investment appraisal, with exception to ROC, I told you, only relevant cash flow should be considered. In all the methods except ROC, everywhere we take cash flow, so cash flow becomes more important. These are future, incremental or cash based or opportunity cost. These are future cash flows. Cash flows which you are going to pay, which you are going to incur or which you are going to receive in future. Incremental cash flow. Now what is incremental cash flow? Sometimes you may have to face a decision like this, that company has an existing machine and company is planning to replace it by a new one, but existing machine is in working condition. It is in good working condition. So there we use incremental approach. Existing machine is generating a cash flow of say $10,000 a month. The new machine, it is going to new machine is going to generate cash of $12,000. So $10,000 with the existing machine, $12,000 with the new machine. What is the incremental? $2,000. We are interested in $2,000 because anyway $10,000 was generated. Additional $2,000. So incremental is the difference between the old and new, right? Cash based or opportunity cost. Now for example, your opportunity cost example, say you are having a shop, right? That shop is given on rent. You are getting a rent of say $5,000 a month. You are getting a rent. Now you have decided to start a new project. In this project, you are going to use this shop which you have. Now what will happen? When you use that shop for your own purpose, own investment, own business, that rent of 5,000 will be lost. Yes or no? So that 5,000 is opportunity cost. You are losing that 5,000. Getting it? Because once you use that shop for your own business, you cannot give it on rent. So that will be a loss, cash loss, cash. So this is also a cash flow. It's an outflow, but it's a cash flow. Okay, so you have to take all future cash flows. You have to take the incremental cash flows and you have to take some opportunity cost, cash based or opportunity cost. Fine. Ignore. When you do the calculation, when you take the cash flows, you have to ignore number one, sunk cost, cost which is already incurred. For example, suppose you have done a research, company has done a research and found out that you can manufacture this product. We can manufacture this product. For that we needed a research. Research is already done. Already payment is made. Already the payment is made for that research. Now whether you go for this product or not, whether you manufacture this product or not, the research expenses are already incurred. So it's a sunk cost. It's not going to affect your decision now. It becomes irrelevant. Okay, because anyways you don't start the product, or you start the product, that expenditure is already done. Yes, but if the expenditure is supposed to be done, then it is relevant. Okay. Committed cost. Some costs are committed whether you start the project or not. For example, suppose there are some workers to whom you are making an idle payment. Why? Because you don't have the work to give them. So you are paying them idle work. For idle hours you are making them payment, because company doesn't have the work to give them. So we have to make the payment. It's a fixed cost. Whether you work, whether the company is working or not, it's a committed cost. Now suppose you start with a project. then these workers will be allotted this particular project. These workers will work on this project. So they were paid. Anyways, they are going to pay it, right? If you don't start with the project, still they are paid. And if you start with the project, then also you have to pay. So this is a committed cost. So we should ignore this. Don't take committed cost, because anyways, whether you start the project or not, this has to be paid. It is not for this particular project. Okay. Non-cash item, obviously depreciation ignore because there is no cash flow. Allocated cost, some fixed overhead. For example, say a factory rent. If you start with this new project, okay, the factory rent will be allocated to this project. Don't start with this project, still the rent figure is going to be same. Remember, factory has a rent of say per annum $50,000, right? If you don't start with this project, still that $50,000 is unaffected. So you start this project or you don't start with this project, that 50,000 rent will be as it is. Understand? So that becomes irrelevant for us. So we need to ignore all this in our calculation. Okay, guys, let us proceed. This is very important. Very important. I'm telling you. In the third chapter also, this concept is going to be used thoroughly. Remember. So very important. Relevant cost. Okay. So all this cost we have already discussed. I have discussed this in detail, and this is just the explanation for those points. Now, let's take this example. Test your understanding 3, relevant cost. A manufacturing company is considering the production of a new type of widget. Each widget take 2 hours to make. Fixed overheads are apportioned on the basis of $1 per labor hour. So this is apportionment. This is nothing but this allocation which we have to ignore. This is some fixed cost which is allocated or apportioned. Remember, whether you manufacture this new product or not, the overall fixed cost, say for example it's a rent or fixed labor, that is not going to be affected. Okay, so there is no additional cash outflow. That is the reason we will ignore this. So we are going to ignore this. If the new widgets are produced, the company will have to employ an additional supervisor at a salary of 15,000 per annum. So this is the relevant cost. Because of this new project, you are going to pay 15,000 salary. Because of this new project, you are going to appoint that supervisor. So this is the relevant cost. And company produced 10,000 widgets. This is a quantity which is not affecting us actually, is not giving any effect on this question. So what are the relevant cash flow? Only this 15,000 salary is the relevant cost in this example. Okay, let's take one more question, additional question. Company is evaluating a proposed expenditure on an item of equipment that would cost 1,60,000. So 1,60,000 is a capital expenditure. Okay. A technical feasibility study has been carried out by the consultant at a cost of $15,000 into benefits from investing. A technical feasibility has been carried out. Already this expenditure is incurred. So this becomes a sunk cost. It is a sunk cost. So again it becomes irrelevant. So you ignore this. See, this expenditure is already incurred. Understand? Whether you start with this project or not, this $15,000 has been already paid. So it is not going to affect us. It is not going to affect our decision, right? So hence we'll ignore. And it has been estimated that the equipment would have a life of 4 years. The annual profit would be $8,000 after deducting debris. So depreciation is a non-cash item you have already deducted. Remember, it's a non-cash item. We have not paid for this 40,000, so I have to add back. So 8,000 plus 40,000. Annual charge of 25,000 for the share of existing fixed cost, not because of this project. Already there is a fixed cost which the company is incurring. and this particular new project is going to share that. Now understand, this sharing, this allocation is something which is non-cash. Because of this project there is no additional cash outflow. Understand? So this 25,000 is also something called as allocation of fixed cost, or we can say apportionment of fixed cost, which you have to ignore. So this is also deducted. After deducting, so we have already deducted, understand, we have already deducted 40,000, we have already deducted 25,000, and for both there is no additional cash outflow. Depreciation we don't pay only, and this 25,000 is also not cash flow, because if you don't start with this project, the fixed cost, total fixed cost as it is, right? So the point is 8,000 plus 40,000, that is 48,000, plus 25,000, so 48 plus 25, 73,000. 73,000 is the relevant cash flow. Okay, this is a relevant cash flow, right? Now we go to the next method. So I hope the concept of relevant cost is very clear. ROC is very clear. Let's complete this chapter. Payback method, very simple method, basically very simple, and after this method, this chapter number 2 is done. Okay, payback method of appraisal. What is payback? See, as the name suggests, payback, it is actually a duration, time in which the project will pay back your initial investment. Project will pay you back your initial investment. It is time taken to recover the investment made at the beginning. Time, it's a duration. Answer will be some years, some months. Say 3 years and 4 months, like that. Answer will be in duration. So it is time taken to recover your investment. Okay. Now, decision rule, only select projects that pay back within a specified time period. For example, company has a target of recovering the cost in 4 years. Calculate payback. This method, use this method. This method will give you the time in which you will be able to recover your money. Say for example, you have a target of recovering in 4 years and the payback you are getting is 3.5 years. Then you should accept the project, because this project will pay you back your investment in 3.5 years. How to calculate, we'll see later. Okay. And number 2, choose between options on the basis of fastest payback. You have you have 2 alternatives, project A, project B. You want fast recovery of cash flow. So calculate payback for both A and B and select the project with a lower payback. How to calculate payback? First possibility, you have a constant cash flow. Constant cash flow, what does it mean? For example, the project is of 5 years and the cash flow every year is 20,000, 20,000, 20,000, 20,000, same constant 20, 20, 20, 20 every year. But suppose if cash flows are unequal, 20, 22, 19, 24, that example will take later. Okay. Let us start with annual cash flow, which are constant. What is the formula? Payback period will be initial investment divided by annual cash flow. Very simple, very simple. Let us see. Question number 4. An expenditure of $2 million, $200,000, $2 million, sorry. So that is 20 lakhs, is expected to generate cash flow of $5 lakh each year for next 7 years. What is the payback period for this project? So what you will do? 2 million, so that is 20 lakh dollars, divide by $5 lakh per annum we are recovering. So that comes to how much? 4 years. Correct. So 4 years is the answer. Every year $500,000, $500,000 we are going to recover cash flow. Okay, and how much you are going to spend? It will be $2,000 million. So $2,000 million is the initial cost and $500 million you are going to recover. So in 4 years you will be recovering. It's very simple, right? Now, sometimes you may have an answer in fractions. For example, say 3 years, okay, and you are getting say 3.5 years, suppose. Now what is 3.5 years? It is 3 years and half a year, right? So that 0.5 years you will multiply with 12. So that comes to 6 months. So 0.5 years is equivalent to 6 months. So your answer over years will be 3 years and 6 months. 3.5 years is nothing but we can say 3 years and 6 months. Okay, 3 years and 6 months. Okay, test your understanding. Payback, fine. A project will involve spending 1.8 millions now. Annual cash flow from the project will be 350,000, right? And what is the expected payback period? So what is your answer? It will be $180 million, right? 180, no, sorry, it will be 1.8. So 1.8 divided by 0.35. So that comes to how much? 1.8 divided by 0.35. So 5.1428 something years. This is the answer, right? What is the initial cost? 1.8 million. And what is your recovery every year? It is 0.35 million, 350, right? So $0.35 million. Now how to convert this 4 years into, this is 0.14286 years into 12, because I want to convert into months, right? I want to convert into months. So your answer will be how much? 5 years, and this is 0.14286 into 12. That comes to approximately 1.71. So that is 1.71 months. So approximately 2 months. So 5 years and 2 months approx is the answer. Okay. So we can convert the fraction number of years into months by multiplying with 12. This is what the question says. Okay. Now let's proceed further. Uneven cash flows. You don't have regular cash flows, and constant cash flows we don't have. Okay. Chalo, let us understand. Question number 6. Payback with uneven cash flow. A project is expected to have a following cash flow. What is the outflow in the bracket? That means you are going to invest 1900. You are going to invest 1900, and these are the inflows. Inflow, it is positive. Bracket indicates negative, right? So it's an outflow. So this is an outflow and these are the inflows. What is the expected payback period? So in short, the question is what? The investment in the project is 1900, right? In year 1 you will be recovering 300, 500, 600. So how many years it will take to recover 1900? That is a question basically. So what we do is, for the time being, ignore this 1900. What you're going to do is, you're going to calculate cumulative cash inflow. Cumulative cash flow. So this is 300, this is 800, then 800 plus 600, 1400. 1400 plus 800, that comes to 2200, and then 2700. Correct? Okay. Now $2,700. Now you want to recover what? You want to recover 1900. Now see, if I cumulate the cash flow, 1900 is getting recovered over a year. You can just write down the solution. So cumulative cash flow, I have calculated 1400 and 2200. So up to year 3 you are recovering 1400, but up to year 4 you are recovering 2200, which is more than 1900. So your payback, your project is paying you back in how many years? More than 3 but less than 4. exact 3 years you're not getting. You're not getting exact 4 years. So how you are going to present this? So write like this: cost of the project. What is the project cost? 1900 less how much you're going to recover up to year 3. Up to year 3 1400. Here this one, right? So this 1400 you are going to recover up to year 3. So to be recovered up to year 3, that is 1400. So what is pending now? 500. So you want to recover 500 in the last year, right? So that is to be recovered in year 4. Now what is the cash flow for year 4? Not cumulative, only for year 4 it is 800. This 2200 is cumulative, don't see that amount. What is the 4th year cash flow? It is 800. In the year 4 you have to recover only 500. So what will be your payback period? It is obviously 3 years, plus you need to recover 500 out of 800. In year 4 you want to recover 500 out of 800. So 500 divided by 800 years, but I want answer in months, so we better multiply with 12. So this comes to how much? 500 divided by 800 into 12, that is 7.5 months. So I can say 3 years and 7.5 months is your answer. I hope the point is clear. Very simple, right? Now let's take one more example. Payback with uneven cash flows. Calculate the payback period in years and months for the following project. 0, 1, 2, 3, 4, 5 years. There is an outflow of 3100 and 5 cash flows. So I'm just ignoring this for the time being so that I can do the calculation. What you have to do is you have to write cumulative cash flows. So 1000 plus 900, so 1900, plus 800, so 2700, plus 500, so 3200, and then 3700. Okay. Okay, now I want to recover how much? What is my outflow? 3100, which is in the bracket, and these are inflows. So 3100 investment, initial capital cost, will be recovered in how many years? Between 3100 will be recovered between the 3rd and the 4th year. So your answer is 3 years and some months, that is for sure. So how you are going to present this answer? Cost of the project, you can write like this: cost of the project is 3100. The initial capital cost is 3100, right? Minus to be recovered. Up to year 3. Till year 3, how much you are going to recover? 2700. Up to year 3, 2700 is recovered, right? So over here, okay, so what is left now? 3100 minus 27, so 400 you need to recover in the 4th year. What is the inflow for the 4th year? What is the cash flow for the 4th year? It is 500. Out of 500 I have to recover 400. So to be recovered in year 4, right? In year 4 you have to recover 400. So what is your payback period? It is obviously 3 years plus 400 you have to recover out of 500. Correct? This will be in years. So 500 for one full year, 400 how much? Unitary method, cross multiply. So 400 divided by 500 years. This will be 0.8 years. But if you want answer in months, I am going to multiply with 12. Okay, so your answer will be what? 400 divided by 500, this is 0.8 into 12. That comes to 9.6 months. So your answer is 3 years and 9.6 months. So approximately we can say 10 months. So approximately 10 months. Okay, so approximately 10 months is your answer. So 3 years and 10 months approx answer. I hope it is clear. So this is about calculation of payback. Now let us discuss advantages and disadvantages of payback. Very simple. First of all, it is simple. It is simple to calculate. We can see it's quite simple. It is useful in certain situation where rapid technology is used. It is used for those businesses where the product become obsolete very fast. Now say for example, let us say about Samsung phones. Samsung S26 Ultra, right? Now what happens, company is spending so much of funds in this particular phone, right? Next year some new model is going to come. So this existing model can be sold by the company only for say 1 year. Only for 1 year, and in that 1 year sale, company has to recover the entire cost, because in the next year people will expect the new model. So here the product is becoming outdated very fast. In all businesses where product becomes outdated very fast, rapid technology, there I need this particular method. Improving investment condition. Now say for example, if the recovery is faster and we have a better scope of investment in future, better investment future. So if the recovery is faster, I'll get my cash flow quickly. I can again reinvest in better improved condition. Okay, so improving situation, improving investment condition, their payback is useful. It favors quick return because we get cash flows quickly. That is the objective. Helps companies growth, minimizes risk, maximizes liquidity. The sooner you get the cash flow, you get a better liquidity. Lower the payback, better liquidity. I get my cash early. Minimum risk minimizes that I receive my cash early. So if I receive the cash flow in a lesser payback period, that is going to reduce my risk because I have recovered my money. Disadvantages: it ignores returns after the payback. For example, say here we got payback of 3 years and 7.5 months or 8 months approx. So what we are going to earn in the 5th year, we are not considering. We are just concentrating on recovery of the cost. So what will be the cash flows after the payback period, we are not considering. For example, if you have a project of 5 years, then all 5 years cash flow should be considered. But here we are ignoring the cash flows which are after the payback. It ignores time value of money. We are going to cover in the next chapter, but we are ignoring time value of money over here in this particular method. Here also in ROC also. It is subject to no definitive investment signal. Okay, here also it depends on the type of business. It depends on the accounting method. Okay, and is not a definitive investment signal because we are ignoring time value of money. Definitive investment signal you will get by a method called as NPV, net present value. We'll be covering in the next chapter. It ignores profitability. We are not considering profitability. We are just concentrating on recovery of the cost. Whether the project is profitable or not, we are not talking about that. So whatever we have discussed, it is detailed discussed over here, right? You can just go through that. Now let's proceed with test your understanding. Example 8. Which of the following is an example of the relevant cash flow to be considered in an investment appraisal process for a new project? Relevant. Which one is the relevant? Market research expenditure already incurred. It is a sunk cost. It's a sunk cost. It is not going to affect your decision whether you start with the project, don't start with the project. This is irrelevant. So this is not relevant. Additional tax that will be paid on extra profit generate. Yes. So you generate additional profit and on that you have to pay tax. So this appears to be relevant. Centrally allocated overheads that are not consequences of because of this project, this is not going to be incurred. Irrelevant. Tax allowable debris is anyways non-cash item. So depreciation is a non-cash figure. So additional tax B is relevant. Let's go to the next one. Garfield company is considering whether to enter into a new project. The machine which would be used to produce the goods for a contract was purchased 7 years ago at $80,000. So this is a sunk cost. It is being purchased. It was purchased 7 years ago. So not relevant now. Today we are not going to spend 80,000. What is the value of that machine today? Value of that machine today. That is important. Depreciation is on straight line basis. Not interested because it is a non-cash item. The machinery has been idle for some time, and if it not used on this contract would be scrapped and sold immediately for an estimated figure of $5,000. So $5,000 is the value of this machine today. Today I can sell the machine and get $5,000. So if you are using this machine for our new project, 5,000 is my outflow. This is relevant. After use on this contract, the machine would have no value, no salvage, scrap, zero, but would have to be dismantled and disposed of at a cost of. So this is the cost of dismantling. Suppose if you use this machine for 5 years, okay, after 5 years, if you suppose not using for this contract, after use on this contract, the scrap value is zero. But suppose if you after 5 years there is no salvage value, so only the dismantling cost is 1,500. Remember, ignoring the time value of the money covered in the chapter later, what is the relevant cost of the machine to the new contract? See, this 5,000 is obviously relevant. This is my cost for this project. Correct? We don't have to take 80,000. That was 7 years ago. 5,000, and plus this is also relevant because if you are using for this project in the last year, I have to spend 1,500 for dismantling. So this is the cost which we are going to incur in the 5th year to dismantle the machine, sorry. So 5,000 plus 1,500, 6,500 is your answer. These two are relevant. Okay, let's go to the next one now. Which of the following is an advantage of payback? It's an advantage. Number 1, it takes into account the timing of cash flow. Is it an advantage? It's a disadvantage. Time value of the money is ignored in this payback. So this is not an advantage. Then it uses accounting profit. It takes cash profits. We use cash inflow. It takes into account cash flows after the end of the payback period and therefore the total project return. It takes into account cash flows after the end of the payback. In fact, in payback period, cash flows after the end of the payback is ignored. Okay, so this is also not an advantage. It can be used as a screening device for as a first stage to eliminate obviously inappropriate project. This is correct. So if you use payback period, you won't be getting a definitive result. You will get the definite result after we do chapter 3 net present value. That method we are going to use later. But obviously payback will give you a fair idea. It can screen the projects, any project which gives my cash flow after more number of years, delayed recovery, that I should not consider. So this screening of device, this is a screening device. It can screen the projects. That is the correct answer. So D is right. Which of the following statement is not true? Okay, the return on capital employed method of investment appraisal takes into account the length. No, ARR, it's a drawback. It's a limitation. It ignores the length of the project. So this is not true. Focus on early payback can enhance liquidity. Yes, if payback period is less, Your recovery is fast, so liquidity is better. Investment risk. Investment risk is increased if the payback period is longer. Obviously, longer the payback, later will be the recovery, right? Short-term forecast are likely to be more reliable. Obviously, if you are forecasting for a short period, your estimation will be more correct. You are going to forecast for a longer period, your estimation, your judgment may be wrong. Right? I hope it is clear. Now we take the last example and then this chapter is done. This is the last example. Okay. Read the question. A company is considering purchasing a new machine at a cost of 1,10,400 that will be operated for 4 years. Okay. After which it will have to be sold for an estimated amount of 9,600. This is the salvage value, scrap. Account uses straight line policy for debris. Okay. Forecasted operating profit. Operating profit means profit before interest and tax. This is the profit we need for ROCE, directly given to you. Okay. So these are profit before interest and tax for 4 years. Select the payback period and the average return on capital employed. Return on capital employed calculated as average annual profit divided by average investment. So we have to use the second formula. We have two formulas for ROCE. So we have to use the second formula, average investment. Let us calculate and check. Okay. So first of all, let us calculate average rate of return. That will be very simple. So we just add these 4 and divide by 4 to get the average. So average, let us check, 39,600 plus 19,600 plus 22,400 plus 32,400 divide by 4. So 28,500. 28,500 divide by average investment. These are profit before interest and tax. So let us calculate ARR. Okay. So average investment, how will get? Cost plus scrap divided by 2, right? So 110,400 plus 9,600 divided by 2, that is 1,20,000 divided by 2, 60,000. So this is 60,000 into 100, that comes to how much? So 28,500 divided by 60,000. 47.5% is the answer. So return on capital employed, either this or this. So one thing is for sure, B is not correct. B and D are not our answers. That is for sure. Now only A and C. Let us check that also. Okay, so 47.5% is your ARR, return on capital employed. Now for payback, remember, for payback I need cash inflow. Only in ROCE we are using profit before interest and tax. In all other methods we use cash flow. Now this is profit before interest and tax. So depreciation must have been deducted above. After deducting depreciation, you must have got this PBIT, profit before interest and tax. So you have to add back depre now. You have to add back depreciation to get the cash inflow. So how much is the depre figure? How much is the depreciation figure? It is 1,10,400. It is 1,10,400 minus 9,600 divide by how many years? 4 years. So 25,200 is a depre figure. 1,10,400. I just do repeat again. 1,10,400 minus scrap is 9,600. Divide by 4 years. 25,200 is depreciation figure. So you have to add that to cash to get the cash inflows, right? So I'll do the working over here. So year 1, 2, 3, 4. You are given profit before interest and tax. Okay, how much is it? 39,600, 19,600, 22,400 and 32,400. 39,600, 19,600, 22,400. Then you add back debris. So here I am getting cash. There is a depreciation figure. Let me write down that also. Depreciation is 25,200. 25,200. So what is my cash flow? I have to add. So 39,600 plus 25,200, that comes to 64,800. Then 19,600 plus 25,200, that comes to 44,800. 22,400 plus 25,200, 47,600. And 32,400 plus 25,200, that comes to 57,600, right? We have to calculate cumulative cash flow. Cumulative cash flow. So 64,800 plus 44,800. 64,800 plus 44,800. 1,09,600 plus 47,600, that comes to 157. Okay, and plus 57,600, that comes to 2,14,800. But my cost of 1,10,400 will be recovered somewhere over here, between the second and the third year. So your answer is 2 point something. So 2 point something, that is for sure. So obviously this is the answer. This cannot be the answer. Your answer is between 2 and 3. Between 2 and 3. So answer is 2 years and few months. So this is the answer actually. This cannot be the answer. 3.89. But still, let us calculate now. So what is the cost of the project? Cost of the machine. Yeah, cost of the machine. We know the answer is A, because your answer is between 2 and 3. So 2.02 must be the answer. That's obvious. But still, let us complete the solution. So 1,10,000 cost of the machine, 1,10,400 minus to be recovered. To be recovered up to year 2, up to year 2, till year 2 you are recovering 1,09,600. Okay, so 1,10,400 minus 1,09,600, so that is only 800. This is to be recovered, in year 3, to be recovered in year 3. So what is my payback period? It is 2 years plus I have to recover only 800 out of. In the third year, what is the cash flow? In the third year, this is the cash flow. This is a cumulative figure. Don't take this. 47,600. So divide by 47,600 years. So that comes to how much? 800 divided by 47,600. That comes to 2 years plus 0.0168. So 0.02 I am writing year. This is in years, remember. So the answer is 2.02 years. 2.02 years. So obviously the first one is the answer. This one. This is the answer. 2.02. Correct? You can just confirm over here. Right? Okay. So that's it with this chapter number 2. Guys, I hope you like this video. And if you want to buy the videos, my lectures, you can visit the website Let's Learn, or you can call on 844 right, 8919. This is the number you can call, and do subscribe my channel for further videos. Thank you for watching.